Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, we have Jay Gragnani. He's the head of research and client engagement over at Nasdaq Dorsey Wright, and we're going to take a checkup on the markets here. Jay, it's great to have you with me. As always, June, the S&P 500, quite a month.
It really was. You know, June historically has not been a great month for the market. If you go back and you look historically, out of all 12 months, it's typically averaged in the 10th position, meaning it's the 10th best performing out of 12. Nothing a whole lot going on typically in the month of June, the summer month setting in. 2019 was very different though. You saw the S&P 500 in June rally almost 7%, about 6.9% specifically. And when you go back and you look at that historically in modern times, and if you just go back and you look since 1950 forward, that comes in at the number 2 position for June, meaning June of 2019 was the second best performing June that we've seen since 1950. The first best was back in 1955. And so when you look across the board, it's really interesting what you saw during June. You saw a very strong rally in the sense that you had a lot of the indexes, the traditionally cap-weighted index, S&P 500, Nasdaq 100 indexes, all moving to new highs. But what you also saw is a lot of broad strength underneath the surface as well. And so you really saw a broad rally within equities, but also within a lot of other asset classes as well.
All right, well, let's take a look at the chart on 6-month returns, because the obvious question is there more juice in this market to replicate that performance in the first half?
So it's interesting you mentioned that, because June obviously was very good, but when you go back and you look at the first 6 months of this year, it's been historically very good as well. And if you look just on the chart here, in the first 6 months of the year, 2019, the S&P 500 is up over 17%. And you go back and you look, and that's the 31st time, so 31 years, going all the way back to in the S&P 500, that the S&P has seen a double-digit gain in the first 6 months of the year. The biggest question, though, I think on everybody's mind is there anything left in the tank? Does the S&P 500 have the ability to move further, have the ability to go farther? It's sitting here very, very close to new all-time highs. And when you historically look back, again, just looking back at the numbers, what we've seen historically is that there's a very strong bias towards seeing strong returns in the back half of years that show strong first half of the year returns. And what I mean by that is out of those 31 years that the S&P 500 has rallied double digits, 10% or more, the average return in the second half of those years is over 6%. That compares to, in all years, of just a 3% rally in the back half of the year. And so when you put it into that perspective, you know, there certainly is a bias towards a strong first half of the market leads to a strong second half of the market, not only in terms of magnitude, meaning that 6% magnitude move, but also in terms of we'll call it batting average. In 23 out of those 31 years, we've seen a positive return in the back half of the year as well. So time will tell. Obviously, we have 6.5 months now to see if that comes to fruition. But if history is any guide, you know, we've seen a strong first half of the year lead to a strong second half.
All right, well, the next question is, where do you focus right now to drill down even more? And you have the dynamic asset level investing tool. Take a look at that as well. That's what you use at Nasdaq Dorsey Wright.
So this is our primary compass that we look at from a relative strength perspective. And so when we're putting together portfolios and talking about general markets perspective, this is always in the back of our mind. And what this stands for, DALI, Dynamic Asset Level Investing, it's simply a relative strength ranking of asset classes out there in the market. And so when we look at that today, on the left-hand side is the strongest asset class, which is domestic or U.S. equities. That has been unchanged for the past 3 years. Coming through this year so far, it's still been number 1. Sitting right there at number 2 is international equities, and you see fixed income in there at number 3. And really this year, all 3 of those asset classes have produced absolute, generally positive returns. Domestic equities, though, because this is a relative strength ranking system, domestic equities has seen a greater magnitude in terms of returns, as we just looked at with the S&P up, 17%, closing in on up close to 20%. So when we're looking at strength today, it continues to be the U.S. equity market. It continues to be the growth-oriented sectors of the U.S. equity market. Technology very specifically remains the number 1 ranked sector that we're looking at today. So when we're looking at the market, looking towards putting together together portfolios or allocating money, that's where we're focusing on today, and avoiding those areas that you see down to the right, things like foreign currencies, things like cash, things that frankly tend to be more kind of safe haven, lower beta type of asset classes as the market is continuing to favor, and we're still seeing the relative strength go towards those more growth-oriented assets.
I mean, it's quite impressive that equities still outperform considering the performance that they've had just within that 3-year time frame.
That's absolutely, yeah, you're absolutely right. And that's, when we look at relative strength, that's really what we wanted to do. We want to try and cut out all the noise out there and really look at the markets, identify what the markets are doing, let the market participants tell us where they are moving in the markets instead of trying to predict that. And that's what relative strength and that's what technical analysis really allows us to do, is listen to that market action and make movements and make decisions based off of that.
All right, Jay, thank you as always for joining us
Great.
at Market Site.
Thank you.
And thank you for joining me on Trade Talks. I'm Jill